All right, good afternoon. It's Nikki Foley here, and I'm so glad that you're joining us. It is noon, so I'm going to go ahead and get started with our presentation today. And so the topic at hand is beyond retirement and planning for long-term healthcare needs today. And so you'll find that this is a topic that we're going to have more conversations about as we really feel like your healthcare costs should be a part of your financial plan. And it's a big part of spending throughout your lives. It really takes focus later in life when you're having to make some of these decisions and handle things individually versus having some supplement from, say, an employer that you've had along the way. And so we feel like it should be part of your financial plan and that you should understand how these decisions may impact your family as well. I'm going to peel back the curtain a little bit and share a few stories and some of the things that we hear on a consistent basis in the meetings that we're having with you and prospective clients, and some of the things that may impact how you think about things. And then ultimately, we want to be your partner to integrate your health decisions with your wealth building strategies. And you can see that we are dedicated to this, as in the beginning of this year, we've historically focused really heavily on your financial strategies. And with the addition of the health side of things this year, we really want to make sure that we marry these two concepts together, and we are integrating those health decisions with your wealth building strategies. And so let's talk a little bit more about this along the way. So from an agenda perspective is, why do we want to integrate Medicare and other medical expenses into your financial strategy? We want to talk about questions that relate to long-term care planning, such as who is going to provide care for you, where you're going to receive your care, and how are you going to pay for that? And then the significance of the health savings account. I feel like in our industry and in the world we're living in, we're just barely beginning to scratch the surface on the value that health savings accounts can provide. And I think you'll continue to hear more and more about that through a lot of different ways, whether it's an employer if you're still working, and then just I think that you're going to see major players that are from the health side of things, like the insurance carriers, talking a lot more about the benefits of a health savings account and how you can use those in retirement. And then some of the essential decisions that go along with Medicare and the timelines that you should be aware of. So with that in mind, let's dig in here and let's talk about integrating your healthcare into your financial strategy and why this is important at any age. And so just to start with and kind of lay the foundation of some things here, one of the primary things that we hear about when we're working with you as our clients and prospective clients is Social Security. And as you may know, Social Security and Medicare are two of the largest expenditures of our federal government, and you can see the dollars that go into that. So it's certainly worth talking about, but we find that you talk a lot more about Social Security when you come to see us and the role that that's going to have in your retirement. And so these two programs represent so much of federal spending that you want to make sure that you know, as you've paid into them, that you're going to get that share of it, right? Well, most people, again, have Social Security as part of their retirement strategy. A lot of the younger individuals that come into our organization, they want to have confidence in knowing that's there. And so we really spend a lot of time on the Social Security side of things and how that might play into your retirement. What we're not talking about and what people don't have as many conversations on is the Medicare side of things. And what we have found is oftentimes the Medicare side is confusing. It's often complicated. There's a lot of moving parts, and so it can be overwhelming. And so people tend to not even have a conversation about their healthcare needs until they become eligible or they're thinking about retiring. And so while it might be in the back of your mind of how much this might cost, there's not a lot of conversations that people come into our office and say, what about my health and my health costs, and how do we fit those in? And one of the things that people talk a lot about is Social Security going to be there? That's top of mind. They want to know what our opinion is, but nobody ever says, is the Medicare program going to be there? In fact, it's projected to run out of money in 2031, and I don't think we've ever had a conversation about, is that something I should be concerned about? And while I don't think it's something you should be concerned about, as there's already proposals every year in Washington to talk about how we increase taxes, can more be coming out of your wages and in your employer's contributions, to help continue to fund that, I think it's important that that's realistic as people are focused on, again, the Social Security side of things and the retirement and income planning, but not the impact of the healthcare on that. And so what we want to do is making sure that you are paying attention and we are helping you pay attention to the role of healthcare along the way and how this might impact your financial strategy, and the role of your family as it might play maybe impactful along the way in this as well. So again, what we find is people approach their retirement with the immediate needs of their health care, and that would be things like enrolling in Medicare, or what am I going to do if I do retire early? How am I going to have that coverage? Or when I retire and my spouse is still working, how do I make sure I know what I should do as it relates to Medicare versus what I need to do? Those are the type of questions we get all the time. But what we want people to help recognize here is health care expenses may grow as you get into your later years, specifically long-term care, and how do we make sure that that becomes part of our conversations? You can see a quote that was given by Schwab, and it was on their website, and it further supports the conversation that we're starting to have here, is that people tend to see market risk as a threat to their retirement portfolios, but a big risk is actually the potential for long-term care needs, and are we planning for that? So let's keep this conversation going here. And one of the things that is a number that people can latch onto is CNN Money says that a couple who retires at 65 can expect to spend $300,000 on healthcare and medical expenses. And so when we do the Retirement Compass, which is our income planning software with you, and that's the piece that we do with you every year on your annual review meeting with us, are you allocating 300,000 of those numbers that you see on the screen to your health care, or is that not something that's really part of your conversation right now? And how do we make it become more of a priority along the way? I'm also going to challenge to say 300,000 hopefully is a good number, but in the event that you have dementia or memory situations that could last a longer time where you need care, those could be stretched. And I feel like more and more we're hearing conversations about the role of dementia and how it's happening earlier. And is that going to fall with caregivers that are in your house, or is that going to be a situation where you really are going to be dependent on long-term care? I would say just really in the last 3 to 6 months, the number of conversations we've had about dementia and the impact on families have really shot up compared to previous years and conversations that we've had. So keeping in mind, this number is 300,000, but every family looks different and could be unique, and that could go up or down. So using that as a middle point, I think is key. So let's talk a little bit about some of the things that are out there. One of the things that I wanted to do, and like I said, is kind of peel back the curtain and talk about some of the things that we hear on a regular basis. And I would say, as we talk about, and you may be familiar, we put up our Paladin plan and we talk about the areas that we want to cover with you, and long-term care planning is a piece of that. And when we get to that bucket, we really have two camps. Either people have a very passionate story and experience that they've had either with grandparents or parents or aunts and uncles or somebody that has impacted how they feel about their long-term care planning decisions. Or on the other side, and there's usually not very many in the middle, they have no thoughts, and it's not something that they have taken time to discuss either amongst themselves as a couple or with their family and their loved ones. And so that's not any different than what this poll shows, that I'm giving you some of the high level details on what views on long-term planning is. So at a high level, there really is a lack of communication along the lines of long-term care plans. And it says here that fewer than half of American adults have seriously had conversations about it. And that's what we see within our organization as well. We find that there's concerns along this, but most haven't saved money or really put thought into how they might allocate some of their funds to long-term care, and certainly haven't done any research along the lines. It's really common that we hear, we want to make sure that we stay at home, or we want to be cared for by our family members, or they have negative experiences about what they have seen and they really want in a facility, and they're trying to avoid that in some way. So when they choose to avoid it, or they don't want to, they know that what they don't want, it's oftentimes then we don't take any further action along the lines of how do we fund this, even if I know that I don't want to be in a facility of some sort. And so again, you're no different if this is you and this is resonating and where you're at, no different than what this poll again shared, that despite anxiety, despite concerns that might be out there, most haven't taken a step towards researching or saving money or taking action in any way. And so whether that's a good or bad thing, it might give you comfort knowing that you're not alone if you feel like this resonates. The other piece that we hear time and time again is the expenses that go along with the monthly payments to facilities continue to shock people. And I know, we meet with several people a week, and as this topic is brought up and they have parents or siblings or somebody going through the experience, the numbers continue to shock people. So whether it is 8,000 or 10,000 or 12,000 or more per month, that is a high cost to people, and it is scary to think about how that might fit into the long-term plan and how your income plan might lay out. So again, those were probably the top 3 things that we hear on a regular basis and how people are responding to this topic. However, don't feel alone. This is no different than how others are responding to things as well. And so our goal today, and as we continue to integrate this health conversation into your financial strategy, is we want to get you thinking. We want to give you the tools to take action and start those conversations, take that next step to get some of this going as part of your financial strategy. And so the next thing is, who is going to care for you? And most people that we talk to really want to make sure that time is spent as close to their loved ones as possible, whether it's children or other loved ones. They do not want to be in a facility and where there is, potentially a break in who is caring for them. They want it to be with those that they are closest to. Again, no different than what is out there in the research and the things that are being reported. Many people become responsible for parents' healthcare management and cost over time. And so for those of you that are listening in today, you may be thinking about it of your role and where you're spending your time might be with your parents, or you have had that experience. But I challenge you to start thinking about, as you move into a long-term care needing situation, what are you going to ask for of your family members and your loved ones? And so as you see some of the statistics here, there's approximately 48 million caregivers in the US, whether planned or unplanned. And I'm going to say that probably a lot of that is unplanned, and they move into this without having very many conversations, because there is an ethical piece that goes along with this and an emotional piece that goes along with it, that you are going to give care to your family members, whether you plan for that or not. And adult children are providing care at a rate of 66%, and adult children are providing financial assistance to elderly parents at a rate of 55%. And so thinking about that, if this is an unplanned situation for you, are you going to be in a position to handle it if it's your parent? And are your children, based off of their age and their kids' ages and just the dynamics of your family, are they going to be in a position to pick up these numbers and pick up for some of the things that might not be planned for? So ask yourself, and I challenge you here on this slide, is, are you planning to leave this responsibility to your children and loved ones? Or can you do something today to make sure that this isn't an unexpected cost and it isn't an unplanned situation? And that really is the point of our conversation today, is to start you thinking about, what does this look like? So who is going to be the person that can support you? Or maybe it's multiple who's, and how can you plan for that? So thinking about the conversations that we've had with you and you're having with others and that we hear along the way, is that last point on this slide is, people want to age in place. They do not want to go to a facility, and that represents, preferred by 70% 96% of Americans over age 50, they want to stay put. Now, there's some people that say, oh my gosh, I'm ready to downsize. I want to be in an independent living. I want that opportunity to socialize. I want some of the things that that offers me. And that is fantastic that if you already have that mindset and know that that might be something that you thrive in, you've probably already started thinking about how this might progress. So starting with independent living, potentially then moving to assisted living and nursing and so forth. And that really is a continuum that you want to look for if you are thinking about care and you are somebody that knows that you already want to be somewhere and you want to be surrounded in an environment like that, not having to change locations as your care continues to grow. Are you looking at some place where you can grow into the level of care that you need? For those of you that do want to stay at home and not have to go through the experience of being in a facility of some sort, what type of expenses are going to go along with that, whether it's medical related or needing help with daily living skills such as bathing and cooking and some of those things, plus the medical expenses that go along if you do need to have some type of skilled care with you. And is your home set up to facilitate some of the things that come along with older age? Is it single level? Do you have all the needs on one level if it's not single level? And so there's expenses that go along with even if you choose to age in your home. And so looking at what are your options? Do you want to stay in this location? What happens if your kids are located other parts of the United States? Will you be near them? Will they come home? Starting to have those conversations are important, even if they're hard to have that communication. And so how will you pay for it really is the next question to address. So who is going to be there for you? Where is it going to be? And what are your preferences related to that? And then how will you pay for it? And I threw some numbers up here so that you could look at the per person costs that go along with some of your expenses. And you'll look at nursing home care as you start to see that cost is getting significant on a monthly basis. And those are the numbers that we hear when you walk in the door and you're telling us about your stories with your parents, that it's costing $10,000 or $12,000 a month, and how that seems so critical to their budget and what might be impacting you along the way, depending on how long they live. You know, the $13,000 that you see there is a private room, and that's on average here in the Twin Cities, or in Minnesota, excuse me. And so looking at what some of these costs could be, and are you prepared to plan for that, and is that part of what your financial strategy is taking into consideration? As you look at that aging in place and being in home, that's a really wide range, but it has to do with the type of care that you're going to need at home. And so some of the other pieces that may go along with how you pay for care and things you want to take into consideration is how much of this is tax deductible and how much is not, and that may play into where you pull your money from. And those are all the things that start to get into really the nitty gritty and things that you want to maybe have a partner such as us to work through. How is this all going to play out? So the how you will pay for things, this is one that I want to make sure that we bring forward, is that Medicare does not cover long-term care expenses. And oftentimes that is confusing and misunderstood along the way when you are thinking about Medicare. We were just in a situation today where we were meeting with someone, and they made the comment, and these oftentimes happen in passing, is, well, when I get to 65, my health care costs are going to drop significantly because I'll have Medicare. And that's not necessarily the case, and we're going to cover some of this along the way. The other misconception is what you see up here is Medicare does not cover long-term care expenses, and oftentimes people think it does. So Medicare is going to deal with medical expenses such as doctor's visits and hospital and so forth. The long-term care deals with non-medical, so things that are impacted by activities of daily living. Those are things called, you may have heard this terminology before, ADLs. So can somebody bathe? Can they dress themselves? Can they toilet and so forth on their own, or do they need support in that? And when you start thinking about the dressing and the bathing and the toileting, and you say, I want my kids to help me, Do you really want your kids to help you? And is that where you want them to spend their time and how they remember you going through this portion of what daily living could look like as you continue to age? And so I challenge you on this one to make sure you're thinking through, is that really how I want it to look when I say I want my kids to care for me? Or am I willing to pay for care to come in for some of those things? And what might that cost me along the way? And so understanding this in more detail is a really key piece of planning. And when I say this is a key piece, let me just back that up, is from a global level, it's a key piece of understanding, and it's important to have conversations about, even when they're uncomfortable. But more importantly, really understanding what Medicare is going to cover and what they're not going to cover, and understanding that in really specific details is something that it's important, I would say, to partner with your financial person, but also having that Medicare role and somebody that can represent you on that side of things, so that you don't have to do all that, but you're depending and using somebody that's focused on this and understands it. Okay, so how are you going to pay as we continue this conversation? There's a couple different categories, and I tried to make this as simple as possible by putting them into categories, but self-funding. That is a very, very common answer of how people want to do this, because it generally makes sense that they are not individuals that want to do insurance, or that's the easiest path. They've done a lot of savings. They are fine not leaving a legacy, and they are okay using their dollars that they have saved for this type of expense as they, move into this stage of life. So self-funding is probably the number one answer that we get. Now, are there ways to control things, and what are some of the things that might impact that category? Is there an opportunity for you to have monthly income coming in despite the fact that you are in nursing care or assisted living? So do you have rental properties? Do you have some way to continue to have monthly income that happens despite you having to be in a work situation? Savings and investment and retirement accounts. And I separate savings from investment and retirement accounts somewhat, at making this very high level and global, that where do taxes come into this? And so do you have dollars available that are already taxed and that you can pull them out tax-free? And what does the role that taxes have on money that you still need to pay taxes on? So that's a conversation we have regularly as it relates to Roth conversions and paying taxes now before they potentially get higher. The one thing that offsets this and that needs to be taken into consideration, and really truly a reason I didn't give an example and show some numbers here, is that because medical expenses are tax deductible, that really could help support where your tax bracket is as you continue to age. So while yes, we want to make some conversions and get some tax-free dollars available for medical expenses, you also may be in a situation where your medical expenses create deductions, which is pulling you into a lower tax bracket. So all of that is a part of what we want to take into consideration and plan for as it relates to your financial strategy. Now, home, there's a couple things that I want to point out here. Is it may be a situation where a portion of your expenses, if you are in a facility, can be offset by renting out your primary home and using that to offset the cost. Another thing that might be taken in consideration if you are a couple and you are thinking about and planning for the fact that one of you may need to go into a facility prior to the other person in the couple relationship. And so what does that look like? In some cases, if you are not in a position to self-fund, it may make sense to consider a reverse mortgage loan. And I'm going to go into that in more detail here in a second, and that's why it's highlighted. Or there's a situation where if you don't have the self-funding option, but you have your home, it may make sense to sell the home and use those as part of what's going to pay on a monthly basis and the expenses that go along with long-term care planning. A couple other options to point out here is long-term care insurance and life insurance. And again, they're highlighted in yellow because I'm going to come in and talk about those here in a moment. And there's also the option of turning on an annuity and an income stream and using that specifically for the medical expenses, and there are some specific carriers that really focus on this type of planning with the annuity product. So insurance, and deciding to use insurance as a way to help you pay for care is an option. If you're a veteran and you have certain disabilities or things that may play into the government being able to help you through veterans benefits, that's something that we want to look at. So if you are disabled or you have injuries from active time in duty, skilled nursing is something that might be available to you under veterans benefits. There's also something known as Veterans Aid and Attendance Benefit, and there's a number of things you have to do to qualify for that, but that might be an option if you are somebody that has served, and that's something that we can also support on and help drive you in the right direction to get some answers of, is there or are there dollars available through veterans benefits that may apply to me? And then finally, a lot of people are in a situation where they don't have the assets available through all those previous topics and areas that we've talked about, and state aid might be something that is going to be applicable either to a parent that you know that you're caregiving for, or in your situation. And so just knowing what that looks like and what type of care and where you might be receiving care based off of state aid. And so with that, let's keep going and talking about a little bit more on a few of those topics that I highlighted in yellow. So long-term care insurance is something that it came out in it didn't necessarily come out in the 2000s, but there was a lot of popularity around it in the late 90s, 2000s. And what we have found, we've gone from hundreds of carriers to dozens of carriers. And that's because there were, you see that premiums continue to go up. There has been errors on the insurance carrier side of things where they have misjudged what the usage might look like, and their costs go up. And so it has been a really thing that has caused either frustration along the way for families, because it was a pay it in and then they never use it, or it was mismanaged in some way. And so long-term care insurance really does have a stain on it, and often people aren't comfortable with making a decision to have long-term care insurance. Things that play into that, again, are carriers are known for raising premiums annually and significantly. There may be limited eligibility, so that has tightened through the years where they aren't paying claims, they are denying claims. It's just something that, again, people have had somewhat of a negative experience. However, as they continue to have the product and make that available, there are things that could offset some of that negativity, such as a return of the amount of premiums that have been paid into the policy if they've never used, but that comes with an additional cost, potentially buying a joint policy with shared spousal benefits. And so this is all to take into consideration. While yes, it may have a stain on it, and there's been a lot of negative publicity, it might be the right thing for you, and you may have had some really good experiences with your family, and it's something that we can get you to. We don't do long-term care insurance within our organization, but we can refer you to somebody that can cover this for you if you think it's right for you. And you can see on the left-hand side there that only 3 to 4% of Americans 50 and older pay for long-term care insurance policies. So something to consider, pros and cons, if you did want to do a long-term care insurance policy. So some of the other things that might be available and might be right for you is a hybrid life insurance policy, that it can alleviate some of the long-term care insurance. And I know when people see life insurance, one of the first things that they say is, life insurance is not right for me. I don't need life insurance. And I want you to turn your perspective to say, it's not for the traditional needs of life insurance and the death benefit that you may be used to, but instead it's having a cash value built up, and you can take advantage of using that in a manner for long-term care planning. There's a lot of tax benefits that go along with that, and that is what is known as a hybrid life insurance policy, and it's one that we've actually started having more conversations within our organization and with you about. There's lots of different ways that can benefit you as you continue to age and how you might use it, and there's a lot of tax benefits that go along with it. So You can take tax-free loans from your cash value for these long-term care expenses. You still maintain that death benefit that might be important to you if you want to pass something from a charitable perspective or from a legacy perspective to your heirs. And then you have the opportunity to have, that cash value there and for it to transition tax-free to the next generation. There's also products in the life insurance realm that really focus exclusively on long-term care options, and those are known as linked benefit insurance policies. There's also riders, or whether long-term care focused or chronic and critical illness focused. And as you can see on the left-hand side there, 84% of long-term care protection right now goes back to these hybrid life insurance policies, where just 16% is being covered by LTCI. And again, this is for the category of you that are interested in having it protected through insurance and those costs being covered through insurance versus say, or a portion of them versus say self-funding or one of those other options we went through on a couple slides ago. Finally, another one to think about, and one that's not talked a lot about, is that reverse mortgage conversation, where a reverse mortgage is a loan where you borrow from your home's equity and it's typically repaid through the sale of the home. Now, again, this is one that you may have seen some negative publicity in the past because they weren't necessarily designed in being used in the way that they were intended. And this industry has really worked hard in the last several years to make sure that people have a good understanding of the place that they could play in somebody's retirement and long-term care planning. And so they're designed to help retirees stay in their homes longer. They're only available to people that are age 62 and older, but they can often be used to pay for, like I said, health care, health expenses, modifications as you continue to age, and you want that in home care along the way. Another place that, again, it's applicable is if you are in a relationship where a spouse goes to a home, and the other spouse is remaining in the home and one goes to a facility, it may be a situation where you need to keep the home for the individual that's staying there, but you need the funds and the equity in your house to pay for some of those long-term care facility costs. And so that would be a place where a reverse mortgage might be applicable as well. The downside is that people forget that there are ongoing costs of your home. So you still have to pay insurance and so forth. And so that still exists even though you're taking the equity out of your home. And so it might be an acceptable option for a client with limited assets and needs this type of option. Okay, what about a health savings account? This is certainly something that has been more popular with the invention of the high deductible health plan. And you may have been introduced to this through your years where you're with an employer, that they have continued to push the high deductible health plans from a cost savings perspective. Nobody's confused that health insurance continues to go up. And so as a solution to that, high deductible health plans have come into play. People have used those to keep their expenses down. So with that in mind, oftentimes you're looking at, I want to pay as little as possible for my health insurance. I'm choosing a high deductible plan. What goes along and complements a high deductible plan is an HSA or a health savings account. When people are trying to keep their costs down, they're not necessarily choosing to take advantage of dropping additional dollars into an HSA. And so I want to challenge that line of thinking for those of you that are still in the workforce and that can even share and spread this information with your peers. This is an absolute prime opportunity for those of you that are still working and may have access to an HSA. You want to do as much as you can with an HSA because it is the only type of an account where you really can go with pre-tax dollars going in, growing tax-free, and you can take withdrawals tax-free for medical expenses. It is a very unique product and an opportunity for you to really control your taxes as it relates to the medical side of things. And so these are a great way, if you can figure out and still have eligibility to use an HSA, to be plugging as much as possible into this type of account, and then recognizing that you don't want to use this, if this is an option, as you go with your medical expenses, push that out as far as possible so that you can use the funds in that account to help pay for Medicare premiums or funds that cover Medicare expenses or long-term care planning expenses later in life. And so the earlier that you can do this, and the more that we can all be advocates for this type of an account, people are going to be able to take advantage of the power of compounding growth and the tax advantages. So this is one, again, that I think we have barely scraped the surface on how powerful these can be. But I do believe that you're going to continue to see more and more from this as an industry, from a health insurance industry, and from employers, because there's so many benefits to this type of account for the long run. So highly encourage, if you have an opportunity to consider the role of an HSA in your financial strategy, this is one that we want to talk to you about and make sure that we're maximizing. Within an HSA, just so that we're setting the scope, and if this is something you're not familiar with, within your HSA account, you typically have a cash bucket that you could use for needs, and you may want to still use some of those. But again, if you could stay away from that and save it for the long term, that is something that would be fantastic for the long-term planning. And then you usually have a bucket that you can grow, and they can have a higher interest rate that goes along with that, often right within that HSA account. And then sometimes there's even the option, once you pass a certain threshold, you then can have access to actually move that over to having a more of a managed relationship, and you can take advantage of even more funding opportunities there and take advantage of more of the upside of the market. And so you really have, if not the one within the account, hopefully you also have an opportunity at a certain threshold to get it out and you can actually invest it, but it's, again, dedicated for the HSA side of things. Okay, let me keep moving here, and now we're going to move into a few more conversations on the Medicare, and then we'll start wrapping it up. So Medicare was signed into law by President Johnson there in 1965, and the key that, what the purpose of it at the time was to establish health insurance for people 65 or older who found it hard or impossible to purchase private insurance. And so where has that evolved to, and what does that look like today? So a quick look at your Medicare coverage choices. Original Medicare consists of A and B as a starting point. A, if you can imagine it like this, I'm a visual person, so imagine A is when you walk into the walls of a hospital. Think of it only as the walls of that hospital. Part B then kicks into play as soon as you start talking to somebody, as soon as you start engaging with the healthcare providers that are there, the doctor, the nurses, and so forth, the x-rays that take place, the potentially some of the drugs that are required while you're in your hospital stay or while you're visiting a clinic. And so that's where Part B comes in. That's how you determine the difference between those two. Part A typically becomes one where you don't have a monthly premium that you have to pay. That's not always the case, and we're going to go through that in a second. Part B, you do have a premium that goes along with it. If you're comfortable and you like the dependability of the original Medicare side of things, but you recognize there may be some expenses that you want to help offset and have some support on, that's where a Medicare supplement would come into play, would help cover some of those expenses that are still out of pocket. If you choose to stay on the left-hand side here, you also have to incorporate Part D. Part D is a requirement, and if you choose not to act on getting Part D or Part B, there could be an expense that goes along with that. Additionally, if you want dental, vision, or hearing, that would be an additional policy that you would have to look at. Or you can scrap the left-hand side of the picture here and move to the right-hand side of things, and you can choose as an alternative to go with a Medicare Advantage plan, and that is going to be Part A and B combined for Part C, and it typically includes Part D plus some dental, vision, and hearing options as well. So again, I'm a visual person, and if you are too, you're looking at this as, do I want to stay on the left-hand side, or am I comfortable moving to the right-hand side? And let's talk a little bit more about how you would make that decision. So at a high level, Medicare Part A, again, is that inpatient hospital care, it's skilled nursing, it is hospice care and so forth, but don't think about it necessarily as the person providing the care. It's the act of walking into that facility or that hospital to get you access to care. When you get inside that facility, that's when Part B kicks in. So what are some of the costs that go along with Part A? Medicare is going to pay for all but $1,632 of your first 60 days in the hospital or skilled care. That may be a situation where you have some type of surgery and you need to move into a rehab facility and stay for a period of time. You don't have anybody at home to support you, and that's why you need a rehab type skilled care provider with you. If you get past that 60 and those 90th days, you can see that there's a cost per day that goes along with that. You would have that as an out-of-pocket expense. Same thing that happens as you see down there with the skilled nursing that may be applicable when I was talking about the rehab. Okay, if you want to offset some of those costs and you weren't expecting it, again, that's where a Medicare supplement would kick in to help offset some of those costs. Let's talk about Part B though before we move to the role of a Medicare supplement. So again, Part B is services from a doctor, other healthcare providers. It's clinical, it's ambulance, it's the mental health, it's medical equipment, it's those preventative services, all the things that happen to you once you get in the walls of a facility. What type of costs go along with that? Anybody that does not have a plan and is enrolling after 2020, it has a requirement that they have to pay the Part B deductible that you see at the top there of $240. They also have a requirement of some out-of-pocket or costs, some co-insurance. So 20% of the cost or all the cost, and you can see how that is outlined on the screen here. So again, if you choose that you want to stay on that left-hand side that I showed you earlier and you want to keep original Medicare, you may want to consider Medicare supplement insurance to help offset some of these costs. There are, like I said before, there is typically not a cost that goes along with Part A. If you've been actively employed in the United States, that is what those taxes have paid into all these years, is covering Part A. You have the expense of Part B, and for those, the standard monthly premium for Part B is $174.70. Again, that is monthly for your Part B cost. You may pay a different premium if you need state aid or Medicaid. You might also pay a different amount if you do not sign up for Part B in a timely manner, and that would be at 10% of the Part B premium for every 12-month period that you delay. Or if you are a high wage earner affected by IRMA, that might also play into this, and that can be significant. Now let's talk about what IRMA looks like, and this is, you may be familiar with this terminology, but let's apply it to the Medicare side of things, that surcharge could be applicable to B and D, the Part B and D premiums. Again, that's the part you have to pay out of pocket for, and it's going to look at the last 2 years, and it's recalculated on an annual basis. And so Social Security lets you know if you're going to be, if IRMA is going to apply to you. If you file taxes jointly, it'll be based off of that combined income of you and your partner, and it shows up as taxable income on your return. That's what's going to impact your IRMA. Yes, you can appeal for this, but remember, it's could be impacting a lot of others in a similar situation around you. And so knowing that just because you are retiring and your income is going to drop, if you're over the threshold, and we'll go through that in just a minute, doesn't mean that you are necessarily qualifying for that life-changing event. It's not just because you retired, because all your peers are going through that as well. So how can this impact you? I want to direct you to, you can see on the left-hand side of the screens, the income levels, and then as you move over to Part B monthly premium column and all the way over to the end, that Part D adjustment, that's what's going to be driving up your cost. So you see that 174 in the monthly premium, and then you move over to the next column, that's the additional adjusted amount that would be applicable to you based off the income level for the total amount in that column where it says total Part B premium. And then you also have a Part D based off of your income. So you can see very quickly when the comments are, hey, my health insurance is going to go down because I'm going to have Medicare. That may not be the case if you look at the cost of Part B. I know I'm also going to have D, and if you're susceptible to IRMA as well, those costs stay up at least for the first couple of years into retirement. Again, all of this is something that we would want to help you plan for and work through with you. For Part B, again, you have a deductible that you have to hit, $240, and then from there, there's that goes down, and you just have your co-pays. All right, let's keep going here, and I've said this a few times, is I was expecting my healthcare costs to go down in retirement, not up. People are often surprised that their health coverage is still unfortunately expensive as you moved into retirement. And so you may want to consider a Medicare supplement or a Medicare Advantage plan to help offset some of this. So again, back to this screen that we've looked at before, is if you stay on the left-hand side and you do want original Medicare, a supplement might be applicable, or you scrap the left-hand side and you say, I want a Medicare Advantage. So what is Medicare supplement? It's private insurance that covers some of that or all of that Medicare cost sharing. So a number that may stick out to you is that $1,632 that you would be required to pay as part of Part A. A Medicare supplement plan would be available to cover that, and you wouldn't have to do that. You would automatically go into having that covered because you're paying a monthly insurance along the way. With Medicare supplements, they are secondary to Medicare, and they are, the thing that they are known for is that anywhere that accepts Medicare takes your Medicare supplement plan. And so your network is extremely large when it comes to Medicare supplement insurance. So high level, that's the benefit. That's what people like about Medicare supplement insurance, is that they know it's taken, and they know no matter where they go, they're probably going to have the care that they're looking for. Now, Part C is on that right-hand side, and you say, I'm going to scrap original Medicare. I don't want a supplement. Instead, I want a Medicare Advantage. It's also offered by private insurance carriers that are approved by Medicare. It includes Part A and Part B. You still have to pay your Part B monthly premium in addition to your Part C premium, but where these are much lower in cost typically than a Medicare supplement, however, you have a restricted network. The good news being in the Twin Cities is you have fantastic health care here, and you have really good networks. Guess what happens? These insurance companies have all of the major networks in the Twin Cities. Where you have to start looking at is, if you are somebody that travels, that you're a snowbird, will I be covered when I travel? And that's what you need to start taking into consideration for a Medicare Advantage. So that's the downside of, it's a limited network, thus my premiums are lower because I'm giving that up, if that makes sense. However, again, the Twin Cities have fantastic coverage because of the networks that we have here. You'll have more co-payments as you go with a Part C plan as well. Okay, and Part D, again, that's your Medicare prescription. You have to have Part D, even if you don't have prescriptions, or you may be charged a late fee, and that goes on for the life, for your lifetime. It does not go away. So you have to make the decision to get Part D when you become eligible for that. And they basically cover your medications and so forth. It either, you have to have an independent one if you go on the Medicare supplement side of things, or it's built into your Medicare Advantage typically if you go that route. Again, premiums can vary, but you may have additional premiums based off if you're Medicaid, or if you have a late enrollment penalty, or the IRMA side of things. All right, so what does this look like, and when do you need to take action? If you are not yet 65, or if you still have a spouse that is working, then that you may not have to have taken action yet, but I'd be happy to review your situation with you. But typically when this comes to you and when you start thinking about it is the 3 months before you turn 65. Is when you can start taking action. That is signing up for Medicare, as well as being eligible for supplement and advantage plans. And so it becomes the first day of the month of the the month you turn 65 is when your plans would go into effect if you decide to enroll at this time. So you have other times that you can enroll, but again, this is where I really encourage you to make sure that you understand what your enrollment periods are, because late penalties could go along with it. So that initial enrollment period is that 3 months before you turn 65, the month of your birthday, and 3 months after. If you get outside of that, you may be in a special enrollment period, and that has limited of what may play into that. You also have your annual election period, and then you can make changes during an open enrollment period. And so this is where people get really confused along the way, and they want somebody to support them. So my key thing would be is if you're getting ready to turn 65 or your spouse is, make sure that you talk with us, and we will help direct you on what your next step should be. All right, what are some of the mistakes that may be made as it relates to Medicare? Even if you postpone Social Security, you may still need to sign up for Medicare during that 7-month window. If you choose to continue working past 65, you may not have to sign up for Medicare, but if you leave your job or your spouse leaves their job and you're on their plan, you have to make sure you know what your enrollment period looks like. And that might not be the case if you're on a spouse's plan. You may not have that 8 months, and we need to look at that with you. Making sure that you pay attention to, if you purchase a Medigap policy, that's that Part C, Medicare supplement, within 6 months of rolling for Medicare, if you switch plans, you may not be guaranteed issue anymore. So again, recognizing that guaranteed issue may be in a really important piece for some individuals, and making sure you know what that looks like. Before purchasing a Medicare Advantage plan, be certain that you know who your providers are within that plan, and if you will be able to go to them freely. And then being aware that with Part D and with any of this, you want to continue to look at it on an annual basis if cost and coverage has changed, so that you're not getting caught off guard. All right, that is just the Medicare side of things and what might be impactful of some of the mistakes that you want to be aware of as it relates to the immediate decisions for Medicare. Again, keeping in mind there's a whole long-term planning that goes along, and that's where we started our conversation. And so next steps, we want to partner with you to integrate your health decisions into your wealth building strategies. And we really want to make sure that this is a conversation that you're comfortable having with us as well as your family members, so that you know that you're not leaving them with unplanned decisions and unplanned expenses. And then if you're in a position that you want to talk about Medicare and you really want to make sure that you understand what all those moving parts are and when it might be important for you to start taking action, I'm happy to have a consultation with you, and you can use my Calendly link or just call the office in either one of these conversations. I hope the information that we've provided today gives you some perspective that maybe you hadn't been thinking about, or some of the risks that might be out there. If you have questions, I'd love to work with you and work through either the financial or the health side of things in partnership with the advisors here in the office. With that, call us with any questions, send us an email, sign up for a quick conversation or a longer conversation if that's of interest to you. And with that, thank you again for joining us today. We appreciate that you took time over the lunch here to spend with us, and please let us support you on integrating these two items together. As a reminder, we have a number of events coming up. You can see them on the screen here. We send out emails, they're on our website, so sign up for any of the most upcoming events, and we hope to see you guys very, very soon. All right, have a great day. Thanks again for being part of everything we're doing, and please call us if we can support you in any way. Take care. Thanks again.